Portfolio Builder members, welcome to our evening update. The news in this evening is about record deficit spending in May. Meanwhile, our portfolio has done very well. In the month of May, we were very defensive, betting on a down market, did better than normal, but not as well as we did last week when the Fed came out, said they're going to probably lower rates. We knew that was cocaine for the stock market, went long, and got out yesterday. So we really hit a record-breaking return in the Diamond membership. That was a 4% return in a single week. And folks, returns like that are too good to be true. So we took the profits. Trade alert was to take the money and run. And we've gotten back to a defensive stance since Monday in our basic program and Tuesday in our Diamond program. Those trades are paying off very well over the last 48 hours, and I can tell you what happens next. Trump loses his temper, raises the tariffs, and we've got a lot of problems on our hands. A quick review at our three portfolios, and then we'll jump into the critical news that's helping us guide our trade alerts this week. So in the basic program, we trade the SPY Monday, Wednesday, Friday. We are doing a strategy where we're selling a covered call to generate a nice little profit. For example, the trade alert today created a $148 credit in your account for every contract you wrote. You have to have 100 shares. Maybe it doesn't seem like a lot of money, but when you do that 3 times a week, and that's what's really nice about the SPY, it has 3 option expirations a week. That adds up. Think about it. 52 weeks, 3 events a week to generate income. You're making a lot of money. Our goal is to pull in around 12% a year, but we're on track to do twice that. So that's the first part of the trade. The second part of the trade we store over here. We take part of the profit and we buy a put option that has a little bit extra duration. That just means it expires a little bit further in the future than our short call option we've written. So we're long the put and we're short the call. This allows us to have an extremely high probability of winning and to also have a lot of downside protection. Now, the downside of this strategy, if the SPY flies higher, we miss out. So that fear of missing out will be the feeling you might have following our program. But the truth is, rarely does the SPY fly up like it did in the last week or it did much of this year, and I highly doubt it will for the rest of this year. So let's just take a look at our Diamond program. It's doing the same thing, except we sold all our stocks. We were long this basket of stocks last Tuesday. Trade alert this Tuesday was to take the money and run. The portfolio jumped 4% in a week, which is a very large return. Now we're only long Apple, and we're doing it with a deep in the money covered call. So we actually collected $850 per contract we wrote. And now that was an in the money covered call, so we don't get to keep all of that, but there's a very healthy profit. If Apple goes up, we get that baked into the cake profit. I took a lot of that profit though, and guess what I did? I bought a put option on Apple so that if Apple does tank, we make a lot of money. Now, if Apple goes up farther to the upside right now, we can't lose. We're set to jet. Apple goes flat, we do well. Apple goes down a little bit, we still make money. If Apple trades between these two strike prices, 182.50 and 187.50, we might lose a little bit, right in that range. That's going to be our weak spot. But if it goes below 182.50, that put option goes up exponentially. So there's a very small weakness in this trade where we can lose money, but for the most part, we generate a profit in almost all outcomes. And so that's really important when you have no clue what's going to happen in the future. And right now, my best bet is that Trump raises tariffs. And if he does that, stocks go down. That's an easy prediction. But what if we're wrong? We just don't want to get wiped out going short the market. So the whale program's doing the same thing. It's been trading the bond market. We called it quits at 126. It flew up to like 132. Drunken Miller's out there saying rates are going to 0. That would push this well above 144. I have a hard time believing that. And so we did the same boring covered call trade for 6 months in this program. And it made a nice return at 126. We called it quits. And we were waiting for an opportunity to go long Amazon and Google after a big sell-off. And we got that. Not only did the entire market sell off in May, giving us a good entry point, but they also have the government on their ass trying to look at any way to scrutinize them. We know that Trump doesn't like either one of them because they have a different political goal than Trump's. And so there's a lot of fear, which is great if you know how to trade the option market. And so we're selling on these two stocks. We're sitting pretty. They did go up after we did this trade, which is great. That means we have nothing to worry about. Our goal here is to make about 0.5% a week with a very, very tight trading setup that's very hard to lose. So we have a deep in the money covered call that we've sold. We collected $360 a contract on Amazon and that's $3,610 a contract on Amazon and $1,960 on Google. So that's a huge credit we brought in. And then we did, again, reinvest some of that potential profit. This is assuming they go up. We get assigned we put a big chunk of that profit into, yes, longer duration put options. So this is basically a way that we can safely bet down in the market and still make money if we go flat or up. So that's the plan right now. Let's take a look at why. First of all, the yield curve is inverted. You can see that right here. You get paid more money to loan the government for a month than you do for 2, 3, 5 years, even at the 7-year. In fact, it doesn't revert until after the 20-year. So you make more money loaning the government for a month than you do for 10 years. That makes no sense. And that's because we have a huge amount of capital betting that they can flip these bonds for a profit. So they're not trying to make 1.87 or 1.92 a year for 5 years. That's less than the Fed's inflation goal. So that would just be suicide. Why would you do that? They think that the rates will go lower and they can flip these for a profit. But what's going to happen when someone like Druckenmiller sells all his bonds because he thinks that the rates have gotten to the very bottom? That's going to cause everyone else who's been hoarding into this play to do the same thing. And when I show you the new government deficit, it's frightening. The interest alone that the government's having to pay on these bonds is getting outrageous, and it's set to get even more outrageous. Throw in a recession and a trade war, and it's going to get out of control. These rates will quickly reverse. So that's one big warning sign. And real quick, just some headlines that just hit right at the market close. U.S. government spending soars to all-time high as deficit hits record for the month of May. This little bar graph just shows the Mays in the past. And so that is a record deficit, U.S. monthly budget deficit. You can see it is rapidly growing. Here's a look at the spending breakdown. Huge chunk of that is going into Social Security and Medicare. And if you look at the age demographic time bomb that's hitting all the big developing countries, this is going to be a bigger and bigger problem. Too many people retiring, not enough young people paying taxes and able to support all these people going into retirement. So this is a huge problem that's going to get worse and worse. Another look at that deficit. So tell me, why can the U.S. borrow for less than ever before? Not ever before, but we're getting close to that. It doesn't make sense. And it's just because people are chasing this bond market for a quick flip because they don't think they can make money anywhere else. Receipts are set to decline. And let's not forget about that $1 trillion, $2 trillion infrastructure project that everybody wants to get done as soon as the Democrats are done talking about impeachment. Apparently the only holdup right now. So there's a huge, huge supply of debt coming our way to the market. And instead of rates rising, which is the normal thing when the supply increases and the demand decreases, instead we have everyone just not knowing where to put their money. They're cashing out of stocks. Only people left buying stocks are the corporations buying back their own stocks. The insiders are getting out. And potentially by the year 2021, the interest alone will reach $1 trillion a year. Our total debt's only $21 trillion. Perhaps the most concerning is that for the first 8 months of this fiscal year, gross interest payments on U.S. Treasury debt hit $354 billion, $46 billion, or 11% more than in the same month period last year. And according to their conservative estimate, we're on track to pay $591 billion in interest payments this year alone. And here is the interest payments in billions of dollars. So this just can't simply go straight up for much longer. And when it does stop, look out under the bond market. But the bigger problem will be a recession that comes when the tariffs rise against China. Now, it's not just, this war is a lot bigger than the extra $350 billion they can put tariffs on. It's a lot bigger than that. And if you look at our GDP, close to 25 trillion, and China's around 12, you might think, well, hey, that's just $500 billion. That's a tiny percentage of their GDP. But this war is more about China being able to be the manufacturer for the entire world on the behalf of these giant tech companies. So the big tech companies are partnered with China, and they really don't want this relationship to break. Because if it does, now all of a sudden, instead of paying a Chinese guy $3 an hour to manufacture electronics, they're going to have to, pay an American 10 or 12. And in fact, what we're seeing is that now it looks like they may move to India. So if this escalates, we're talking about really putting a huge impact on Chinese total exports and cutting them off from key technologies that are going to help them fuel their domestic economy. So they've grown very rapidly, but I believe if this really intensifies, it will really hurt China a lot more than you might think just by looking at our small deficit. So anyways, we're all in on Apple. We got to pay attention to everything going on in it for our Diamond program. And now if you are following our SPY program, remember, Apple is one of your largest positions too. Just because you have the SPY, you got to remember that's one of your biggest positions here. So all the news that I cover from the Diamond program represents the leaders underneath your SPY. So this little Seeking Alpha article is very good. The gist of it is that they knew this was coming and have already been trying to make plans, but India, even though it's growing so quickly, has a lot of fraudulent problems in its government. Now, I like to take a look at Tesla more as a gauge for the corporate credit market. So if Tesla goes under, who's borrowing tons of money to finance this company, that could be bad signs for the corporate bond market. And of course, in our whale program, we have a nice play on the LQD ETF. I believe that domino will fall before, quite likely, any major stock crash or U.S. Treasury crash. So if we can see a leading indicator like Tesla having some serious trouble, getting cut off of the credit supply, and then its stocks tanking, that could be a good sign that there's more pain ahead for a lot of these corporations who are staying alive, not because they're generating a profitable business, but because they're borrowing so much money and using that to finance a very cheap product. So another company that might be like Tesla would be Netflix, and a whole sloosh of these tech companies. So here's a look at Tesla. It has a record short interest right now. It looks like it's about to have a pretty nasty short squeeze. So we'll see. Definitely something to keep an eye on. Another headline about Apple looking to buy out part of Intel's modem business. which may help them with their 5G rollout. I'm not completely sure yet. Now, we did sell our shares of Facebook for a nice profit on Tuesday and then missed out on this dip today, but it is a key position in the diamond portfolio when we do go back to the normal portfolio. And it's also a good position in the SPY, although a small position, less than 1%. And so we can see more and more scrutiny hitting these tech giants like Facebook, Google, Amazon, who have basically a monopoly on their markets. And here's a look at Facebook's chart. Fears of falling demand, surging U.S. stockpiles send oil prices plunging. Of course, this is a bad sign for the stock market. And a look at oil. Here's the drop over the past 24 hours. Gold looking good, but facing that ceiling it's had a hard time breaking through over the past 5 years. Now, if we do get a China trade war and we get all the central banks going down to zero or negative rates and printing money, that is a very nice setup for gold. So definitely something worth potentially buying a cheap call option on right now. But it has the same huge risk. On the other hand, if anything gets delayed about this trade war or inflation picks up and the central banks have to raise rates, then gold has a pretty serious problem ahead. So that's why we've been very careful related to trades around gold. Currently, nothing in our portfolio trading gold, but the whale program might take a jab at that with a tiny position tomorrow. Lumber having a big spike up. Interesting, with oil crashing. Tariff threat has Nintendo moving production. So we're seeing, look, all these companies are just getting out of China altogether, not to just sell products in America, but to sell products worldwide. So this move is not just about our deficit. This is about cutting off China as the manufacturer for most of the world. Little crypto plug, same play as gold, same fear, same reason for it to go up. And now we have Coinbase working with Visa. So nice spike in crypto. We've been telling everybody who is following our crypto portfolio, we're still long. The recommended percentage was 5%. Now we're almost up 100% this year in that portfolio. So it's near the time to take profits and start cutting that back down, because we don't want to have more than a 5% exposure to this asset class. It's such a tiny market that it can be easily swung up or down. And so right now, because of the trade war and because of the devaluation of the Chinese currency, we have a lot of very rich people who are putting a tiny amount of their capital into cryptocurrencies and gold. And so if this does intensify, I think we could see this have another double or triple easily from here. But on the other hand, if the trade war is resolved or delayed, there's no support under these cryptocurrencies, and I'd expect them to have a sharp pullback. So we're looking for the chance to take the profits on this, but I think we got to get a little closer to this G20 meeting and see what happens. 10-year at least has slowed down its descent, and I think that people buying at this level are going to be in some serious pain soon as the yield spike and the bond value drops. Look at the bond markets around the world. Negative rates in Europe, Japan. Makes no sense, does it? There's $11 trillion in negative bonds out there. Here's the conversion rate of the Chinese currency against the dollar. A lot of people seem to think if it breaks 7, all hell will break loose. And their finance ministry has been on the record in the last 2 weeks saying they don't care about that line. But they have been making some steps recently to strengthen their currency alongside pumping more money into their real estate market and also into their stock market. So that it seems like China is really tightening up and gearing up to try to battle the U.S., not trying to make amends. Here's a look at the SPY over the last day. we're set up to do well if the SPY goes down. If it goes up, we won't lose. We'll make a good profit. But if it goes down, we're really set up to do nicely. 1 month. Here's the 1 year. So quite a year. A lot of easy profits all year. Will it last? Can we break through this 294 on the SPY without a trade deal? I highly doubt it. TLT. Again, we've got some people predicting this is going to push all the way to 143. And I find that hard to believe with the huge supply of debt and corporations potentially having an earnings recession. Where's all the tax money going to come to pay for all the interest? Doesn't make sense. So maybe we get another flood into the TLT as a safe haven. But then look out below. And you can see that's what typically happens when we go into these crashes. They get one last hurrah and then they crash when everybody realizes that the rates have to go back up. Emerging markets getting hammered today. Smaller market, easier to move. I look at this as a leading indicator for the SPY, which spells trouble ahead. Now, if we do look at FXI, that's China's large cap companies with an American ETF that we can easily access. A lot of money flowing into China right now. So a lot of money betting this is going to turn around. India has been a very good ETF to invest in over the years. A lot of volatility. Brought it up today just to see what kind of speculations going on that they may benefit from a lot of manufacturing moving out of China to India. Beyond Meat staying up today despite a little bit of a tip-topsy day. Again, we look at the IPOs for a feeling of the risk appetite of the market. Trying to get a prediction before it happens on the SPY is really all this does for us. And again, we sure nailed it on the Diamond program. These were the stocks we were long. They were up huge yesterday. And we told everybody, take the money and run. Moved into that defensive Apple trade that actually does better the worse Apple does. But it doesn't lose if Apple goes up. So that play's doing very well. Here's a look at Apple. What we like about Apple is that it has a lot of buying power behind it in terms of people who want to own the stock. But it also has a lot of volatility. So if you know how to sell covered calls and then take part of that profit and buy put options, sets you up to make money in a lot of different outcomes, up, flat, and down. So just pulling up these charts just so you can see how well we did. We were playing it defensively all of May. Then the Fed came out and we decided to go long, get rid of the covered calls altogether. June 4th, sold them a week later after a record-breaking return for the markets during that period. And so you can see almost all of these did very well. Comcast went up a little bit. Facebook had a huge jump of $14 for us. Microsoft flew up about 12. Wells Fargo went up a little bit, not a lot. They continue to have trouble finding a CEO. Micron is one of the trade war stocks I've identified as a potential leading indicator for the market, and it was one of the worst sell-offs of our stocks we track in that group of stocks. Deutsche Bank, if they go to 6, could potentially have a bankruptcy according to certain analysts. So a lot of people are watching Deutsche Bank like a hawk as a gauge for the bond market getting into trouble. So kind of like watching Tesla for us can give us a little heads up of trouble before it happens. Our Amazon play is doing very well. We would have made a lot more money just being long Amazon, but the Whale Club's not about trying to make a lot of money. It's about trying to make safe money, and that's what it's doing. So this sold a deep in the money covered call on last Thursday and took a good chunk of the profit and bought a put option. So it has one of those high probability profit setups that makes money in 3 directions. We're only trying to make 0.5% a week with this trade and really have very, very little chance of losing even a penny. And so if we can generate 0.5% a week very safely, that's 28% a year. Here's a look at Google. Again, these two had a lot of volatility over the past month, or at least the past year, actually. And that has made this setup very attractive to sell in the money covered calls and then add that downside protection with the put. Now, I don't want you to miss out on tomorrow's trade alert, and I do want to warn you, we are going to raise our basic membership from $9.97 a year to $19.97 a year by the end of the month. So it makes sense to call Dean. He can get you in for $8.97. So that's $100 off the current price, and it's $1,100 off the price it'll be by next month. So upgrade, you'll get 30 days free into the Diamond Club and the Whale Club. So in the basic program, we trade the SPY. That's Monday, Wednesday, Friday. The Diamond Club is trading Apple only right now. That's Tuesday. And on Thursday, if you have enough capital to buy 100 shares of Google and 100 shares of Amazon, you can also follow that program. And that trades on Thursdays. So thanks for your time. Look for a new trade alert tomorrow morning, only for paid folks who follow the Whale Club. So if you're on a free trial, you only get our basic alerts. But if you do upgrade by calling Dean, you can get 30 days free into our Tuesday and Thursday classes. That's 505-322-7515. Thank you, everybody, for your time, and looking forward to a new trade alert tomorrow.